to introduce the first speaker of the day, Richard Gröttheim. He is CEO of AP7. AP7, 45 employees, 80 billion assets under management for 5 million Swedish savers. And I talked to Richard a few minutes ago. He's with AP7 since the beginning, 23 years ago. And they achieved a 10% average annual capital weighted return. And now I notice a few envious looks here in the audience, I guess. 10%, not bad for 23 years on average. So nevertheless, please welcome with me the man who is responsible, CEO of AP7, Richard Gröttheim.
Thank you very much. It's an honor to be here in Frankfurt and participate here and have the possibility to talk a little bit about AP7 and how we approach our investment strategy and how the alternative investment fits into that. Especially then I would talk about private equity. I've been in Frankfurt a lot before I actually joined AP7. I was working for the Central Bank of Sweden. And it was in a lot of, once a month I went there to participate in meeting for the ECB and when that was built up. And I remember one thing actually, it's funny what you can remember, but I remember as I did today, I took the early morning flight and I'm not a morning person, so I was very tired. And at the airport I bought a bottle of whiskey and I put it in the shelf over the counter and I was so tired so I forgot that. That's what I remember from Frankfurt. Anyway, it's an honor to be here, and I will talk about AP7, and the agenda is like this. I will say a little bit, give the background and the picture of AP7. I will talk about our investment strategy, and I will talk about alternative makes the portfolio better, much better. Let's start then with some introduction facts about AP7. In Sweden, we reformed the pension system almost 25 years ago. And it consists of the government pension consists of two parts. One is the income pension, which is the pay-as-you-go, and the premium pension. And then on top of that, we have the second pillar and the third pillar. And I will come back to how we fit in to that. But we act as a default fund within the defined contribution system, which is a part of the government pension plan, as I said. We have 900 billion Swedish kronor under management. Depending on the stock market, it differs from 900 to actually we had just 3 weeks ago 1,000 billion Swedish kronor, and that is around 90 billion euros. That is 40% of the capital. We have 5 million savers, half of the savers. And the way the system works in Sweden, when you talk about the government pension plan, is out of the salary, all Swedes pay 18.5% into the government pension plan. Out of that, 2.5% is put into a defined contribution system. So you can choose among private funds or you can default into AP7. And as I said, half of the people are within AP7. And we think that is, of course, nice to have them there. And we think it's mainly because we hopefully have done a great job. We have a mission, a good pension from generation to generation. And that mission should be interpreted as generation to generation. You have to look at pension savings in the long run, and I will come back to that. Pension savings are for most people 40, 50, maybe 60 years. A young person that comes into AP7, maybe 25 years old, and then the life expectancy in Sweden is almost 85. So then you have an investment horizon of 60 years. And that is, of course, important to remember when you set up a strategy. Generation to generation, also interpreted as we have to take consideration of ESG, environmental and other factors in our savings. And AP7 wants to be leading in being a global diversified equity fund with some leverage, and I will come back to that. We have a tailor-made life cycle product for premium pension. So when you're young, high risk. When you approach retirement, you have to lower the risk, and I will come back to how we do that. ESG and governance, as I said. As the government alternative, we need to have low fees and be cost efficient. We don't make any profits, and our fees today is 5 basis points for the savers. And that has been lowered from 50 basis points just 10 years ago. Transparency and openness, we need to be able to explain everything we do. And of course, alternative investment is more complicated, and I'll come back to that, than other part of the portfolio. So the transparency and openness in that field is more important maybe. We need to make green investment, and that is connected to the ESG and the generation to generation perspective. What can we invest in? We can invest in equities, and market then dominated equities, bonds, private equity. We have been able to do that, and we have done it for more than 20 years. And from January the 1st of this year, we also allowed to invest in real estate and infrastructure. And that's something that we have been asking for many years, because it will make the portfolio even more efficient. And I will get back to how that affected the portfolio and how we approach that. Looking back then, I've been, as the introduction said here, at AP7 for 23 years. And a couple of things, or a few things there. Be long-term. Investments is for the long run. And you have to consider that you should pick up different financial risk premiums for the savers in the long run. And taking financial risk leads to better pensions. No doubt about that, and I will get back to why. And risk-taking should vary over life. As I said, when you're young, when you have a 60 years horizon, you should have a lot of risk in your portfolio. And diversification is essential. You need to diversify your portfolio as much as possible to be able to take that high risk. ESG and sustainable investing has become more and more important for the financial markets, which is a good thing. And you need to do that properly. And especially as a government fund, you can't escape. We are scrutinized, I would say, on a daily basis of what kind of investments we have or not have. Low fees as capital grows. As I said, the financial market or asset management is a thing that where you have an effect of when the capital grows, you can survive with the same kind of cost, and then you have diminishing cost according to the capital, and you can get lower and lower fees, and that's essential to capture that. So, what do I mean by taking risk and the long term? This is a graph that shows the decision making or the choice that you have. Either you can put your capital in on the black line. You have low volatility. You don't pick up any risk premiums. This is basically to put the money on interest rate instruments or in the bank. And the blue line is going into equities and other parts of the risk premium that you can pick up. And of course, the volatility will be higher, but in the long run, you will picking up this risk premium and your return will be better. But you have to survive when the market drops. You have to stick to your plan. Don't hesitate. Don't be worried. Stay there. And if you look then, for example, at the stock market, and you look at it on the long-term horizon, this is almost 125 years. And as you can see in this graph, you have the blue bull periods, but you also have range periods, the orange part here, or yellow part. And during the 70s, for example, you have a bad economic policy with both high inflation and low growth, and equities didn't go up. But if you look at the long-term horizon, if you look at these 40, 50, 60 years, you will always pick up that risk premium. And you have to live with that. You have some periods where you don't have the equity risk premium. And how big is the equity risk premium looking at the long term? Yeah, these are a table where you can see 200 years, you can see 100 years, and you can see on the left-hand side the equity return, and you can see bond and treasuries on the right-hand side, and then you can see the equity risk premium. And it varies around 4 up to 4.5%. We have in our calculations estimated it to be 4.5% in the long run. And why is that? It's because if you have a market economy and you would be able to put money in the bank and have the same return as if you put it in the working capital, the market economy will collapse. And that's why you have these kind of risk premiums, and it's our obligation as a pension saver to pick that up. And there are other risk premiums also in the market, and we'll come back to that. But this is essential for our strategy, how we have approached the investment strategy for the long term. Coming back then to diversification, that should be done in many aspects. You should have many asset classes. You should, of course, have equities, but you also need to move into other asset classes, such as private equity, fixed income, of course, some parts, especially when you approach retirement, but also into real estate and infrastructure. You should have a broad world portfolio, so you should diversify among countries, among companies, and also among sectors to lower the risk in the portfolio, to be able to cope with the high risk that you have in the first place. And as I've said many times now, you have to pick up different risk premiums. Equity risk premium is one. The liquidity risk premium, such as in private equity and also real estate, that is another risk premium. You have factor risk premiums, value-based investments. You have to be able to diversify among them to give the best strategy and the best portfolio. Diversify in time. What do I mean by that? Yeah, especially our savers, they put in money every year in December. That's when the 2.5% is put in. That is a time diversification going forward. But also when you make the investments, for example, in private equity, you need to do them over time. Don't hit the market at one time. Split the investments every year to get the best time diversification. Then the currency risk. In our example, or in our portfolio, we have full currency risk in the Swedish krona versus the euro and the dollar. And the reason is that most of the pension, as you saw in the graph, 16.5% is put into the pay-as-you-go system, which is a krona, Swedish krona-based investment. So the portfolio in the premium pension or the defined contribution part should be put into currency risk to get the best diversification in the overall government pension savings. This graph shows how we then diminish the risk over time. As I said, when you're young, before 55, we are fully into equities and some leverage on that. Then from 56 onwards until 75, we scale down the risk every year. And we have one equity fund and we have one bond fund or fixed income fund. So every year 3 to 4% is are taken from the equity fund and invested into the fixed income fund. And then when you retire, which is in Sweden is around 65 years, you have a 50-50 portfolio of equities and bonds, and then at 75 you have a third in equities and a two-thirds in the fixed income fund. And how has this been working then? Yeah, these graphs, we're very proud of that because this shows the blue line is AP7 and it's over the life of AP7 from September 2000 until just recently. And as you can see from around 2011, where we were allowed, the government gave us new instruction and we were able to fully capture all the risk and have a portfolio with as much equity as we wanted and private equity as well. And that was a change. Before that, we were not allowed to have higher risk than the orange line, which is the average of the competing private funds within the Swedish premium pension system. And as you can see, we have beaten the private funds with almost more than the double. So we have a return on average, as said before, around 10% yearly, which is 400% over time. And the private platform had not more than 200% over that time. And why is that? Yeah, we have a higher risk in our portfolio than the average savers in the private platform have. They have too much fixed income. We have lower fees, of course. That's in our competitive edge to have that. And we are also diversify into global equities more than into Swedish equities as the orange line has. And we have the alternative investment, the private equity, which then will be grown over time. I will come back to that. But as you can see from this graph, taking risk pays off in the long run. You can also see in this graph that we have had periods where we have large drop in our asset under management or the return. We had it, of course, during the crisis in Europe in 2011. And at that time, it didn't feel very well. We had a lot of media coverage, what is happening to AP7, you are losing money. But if you look at this graph more than 10 years later, that's only a small decrease in the return if you look at the long-term picture. But it didn't feel like that that time, and that's why I'm saying you need to stick to your plan over time. Because if you leave the plan at the wrong time in the history, then you will, of course, lose a lot of money. You've seen other dips in the return. In 2016, we had a small crisis. We had it during the pandemic, of course, and today the market is bouncing up and down. But over time, it's a nice return. So stick to the plan, be long term, you will be paid off. Over then to my third point on the agenda, alternative investments in more detail. And I will, of course, talk a lot about private equity, as that is the asset class that we have been invested in since 2002. But I will also show you some graphs on how the portfolio now will be changed as we get the possibility to invest 20% into alternatives in the future. But we have been invested for more than 20 years. We use fund of funds in our investments. And why do we do that? The reason is that we believe generally in an outsourcing strategy. We don't believe that we can get the skill in Sweden to invest in some asset classes as professional as if we outsource it to managers around the globe. And that goes for the passive investment. The base portfolio in private or in global equities is made through three of the largest fund managers or asset managers in the world, BlackRock, Northern Trust, and UBS. In the private equity space, we use 4 providers to help us to find the best funds available to pick up return. And we have a return target of 2% above the global equity, which we actually have achieved. It is, of course, it varies over time a little bit, but the 2% is reachable. And 2% over time, over 40 years, you can imagine that's very good for the pension savers to pick up that risk premium. And we also believe, or we look at this after fees. So we know it's a costly asset class to be in, but if the saver pick up 2% after fees in the long run, it's good for the savers. I've been alluding a bit about the time diversification. It is essential to invest every year and split out the investment over time to get these 2% in return. Also regional diversification. We are invested in the US, in Europe, and also in Asia on the market cap basis, basically, which means that the US market then is, of course, the largest one. We have a mix of buyout and venture, mostly buyout, of course, because that is a less risky asset class than venture, but you need to have a mix between them. Private equity and cost. It is a costly asset class. And then you can argue, okay, a government pension fund scrutinized every day. Why should we defend these high costs in that asset class? And I'm coming back to, if we can pick up the 2% for the savers, then I don't think it's a question of if we pay out fees to these asset managers or the fund of funds and they make a decent work, then we have to accept that fee. But of course, we should also, as a big investor, try to negotiate fees as much as we can. And I said that before, a return target of 2% includes these costs. We don't invest in tax havens, and the reason is that we are a government fund. What's in the portfolio, if you dive into the actual investment in companies and some of the underlying funds, we can't have control of that. So there can be investments in tax havens down in the portfolio. When it comes to the overall structure, where we have the fund of funds, we are very explicit. We don't want any tax haven investments. And once again, it's good for the savers. It gives them better pensions, and that's the reason why we should invest in private equity. The legal work within this asset class is, of course, more complicated, which also creates some costs and workload for us. But once again, it's worth it if the saver can be compensated in a higher return. A little bit then how we approach this when we make the strategy and when we make the assumptions. It's a lot of figures here, but we can concentrate on the left-hand part of the table. You have the sort of risk-free rate, the government bond, Swedish government bond, with a pretty short duration, around 3% in the long run. That's our assumption. The world global portfolio, we believe, will return around 7%. Emerging markets, somewhat more. Small cap equities, somewhat more than the global equity portfolio. Risk premia investing, the value or momentum or whatever is a little bit more than the global portfolio. Real estate, non-listed, 6.5%. Private equity, 9%, and as I said, 2% above the equity, the global index. Infrastructure, 5.7%. Cash, lower than the bond rate, of course, and then we have the finance cost. And on the right-hand part of the portfolio, you see the volatility, EI, the risk related to each asset class. And as you can see, the equity, global equity, we are assuming, or if you look at long-term perspective, it's around 15%. the private equity is 22.5. So it's a much more risk in that, but you are paid off in the long run by getting more return. That's our expectation. And if we then look at the calculation that we have been making, and I will try to explain this graph a little bit, but I thought it was important to put it up because we did this work just a couple of months ago. The blue dot, SAA, is the current portfolio, the portfolio that we had before, and I've described with global equities, some private equity, and also some risk premium investment in emerging markets. At the lower end of the graph here, you can see expected shortfall in percentage point of the portfolio. How much can we lose in theoretically, if you look at the history of that portfolio, and that is then around 20% or between 27 and 20%. The left-hand side, you can see 265 up to 290. That is what we expect the portfolio to deliver over the income pension, and that is the target. We try to deliver over a longer term more than or 2% or more than if you put it in the pay-as-you-go system. And if you then look at the orange dots here, that is if we put in 15% instead of 5% in alternative investments, how much better return and lower risk do we get? And the green dots are then if we put in 20%, which we are allowed to. And as you can see, each of these portfolio where we put in more alternatives, such as infrastructure, real estate, and more private equity, we will move from today 4% in private equity up to almost 10%. We will have 8% in real estate as a target, and then 2 to 3% in infrastructure. But each movement it lowers risk, and it also we get to expect higher expected return. So putting in alternatives in the portfolio gives a much better product for the savers. I want to finish by looking at this graph and give an example of how important it is to be long term. This shows actually investments that we made in 2008 in 2 fund of funds. We use Harbour West that you can see here, and also LGT, which is a European provider. And at that time, we said to ourselves, clean tech, investments into venture and other kind of investment or funds that invest in green solutions for the future would be paying off. And as you know, just a couple of years after, we had the financial crisis. And as you can see on all these lines, the return varies. When you come up to 2014-15, it was actually minus in this portfolio. But we were sticking to the plan, and as you can see now, in the end of 22, we have a positive return, and it's well above the return that we would have had if we have put this money into the global equities. So it's essential. These programs are for 10, 15 years, maybe 20, and you will gradually, of course, pick up the risk premiums, but stick to the plan and be long-term. That is very important. So conclusion, long-term strategy is important. Diversification is essential to be able to capture that risk that we want to. Without risk, no good pension. Diversification among asset classes, and then I include the alternatives especially. Investments in alternatives gives a better portfolio, and I showed that in my graph and in the also the table here, or the two last graphs here in the table. So with that, I will finish and leave it open for questions.
Thank you very much, Richard. Richard, as far as I understood, the new bill has passed the parliament a few months ago, and now you can invest in infrastructure and real estate. So I guess we all get the motives behind this, but how is your approach going to be? Do you outsource again, or?
Yeah, we will outsource a lot of it, but of course we have to add some internal capacity as well as it is. As the private equity investment, it's legally more complicated, and it takes some more actually resources to do it. But we will team up with other real estate investors in Sweden or abroad to create a portfolio over time. So joint ventures are also important.
Okay, thank you very much. I guess there may be some questions from the audience over there. Can we get a microphone, please?
Thank you for the interesting presentation. One question, when it changed, when you showed us the performance chart before, there was a change in 2011 where you said you were allowed to invest in private assets as well. Would you say the performance upswing is only about investing in alternatives, or did you also invest more in equity and less in fixed income? And second question, you mentioned at the beginning that you use some leverage. Could you sort of elaborate a bit of that also? Thanks.
Yeah, thank you for two very good questions. What happened in 2010 was that we have been asking for freely take any risk that we wanted, and the government allowed us to do that. And one part was that we increased the private equity investment that we already had in the portfolio. But the most important thing was that we created a portfolio, and then I come back to your second question, with a global diversified approach, but with leverage. And what we did actually was that we bought from investment bank packages where we borrow money and put that into a global index and leverage the portfolio up to 120% instead of 100% equities. So that was a way of taking more risk, which was better than putting it into other risk, such as emerging markets. We did also put much more in emerging markets, but it's according to theory, it's better to leverage a global equity portfolio than using other risks in the portfolio.
Yeah, a question over here.
Thank you. Just a short question. What is the maximum size you can invest in private markets in your portfolio?
20% from year end.
Mixed in private equity and all the others?
We can use that 20% in either real estate, private equity, or infrastructure.
Thank you very much.
And at the moment, you're at 4%? Is that
4%
correct?
in private equity,
Okay.
and we will increase that to the double size over some years.
2 questions over there, and one here in the front. Yeah.
I would like to come back to the chart where the comparison of the performance of the private fund versus the AP7 has been shown. So I remember the times that the private funds used to be UCITS funds. So is that still the case? So then the comparison wouldn't be quite fair, or are the private funds now also using multiple asset classes?
That's a very relevant question. The answer is that they still are UCITS funds, and with the change in regulation that we got from year end, that comparison will not be sort of fair, of course, because we are allowed to invest in other asset classes, and the UCITS fund, they are not. So the comparison will end, but the history is right.
I have another question. So you recently added infrastructure and real estate as asset classes. Have you also considered to add private debt as an asset class?
Yes, we have considered that, and we will probably do that, but we will first move into real estate and infrastructure, and then we will probably move into also private debt. I think that will also be favorable for the portfolio.
Yeah, there's one more question over here.
Thank you for your presentation. I know you mentioned some of your long-term themes were clean tech, but looking down now, what are some of your long-term themes going forward in the next 5, 10, 15, 20 years?
It's still, we have a theme in more generally green investments. We believe that we will pick up some extra return if we allocate some into that theme. But we do that generally, not only in private equity. We still do clean tech, but we have other green investments that we think will pay off in the long run, as we have this climate issue that we have to take care of.
So I guess we are running out of time. Thank you very much again, Richard. We really appreciate it, having you here today, and wishing you a sound and safe travel home.
Thank you for inviting me. Thanks.